Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name is Manpreet and welcome to Cut to the Chase. Now today is the International Day of Forests, established by the UN in 2012 to spread awareness of how so many aspects of our lives are linked to forests in one way or another. Now I live in Singapore, and while it might be a small place, we have some stunning forest trails around the island which you'll regularly find me on. Reach out to me on LinkedIn if you want some tips for a ramble through the forest the next time you have a day off. Now, rambling through forest is known to improve one's mood, and the mood in equity markets certainly has been improving. In the US, much has been written about the death cross, or a technical pattern where the 200-day moving average crosses over and below the 50-day moving average. However, this may be a formation where the bark is worse than its bite. As one report I came across noted, the death cross had predicted 11 out of the last 2 equity bear markets. So not a great track record there. Friday's bounce, though, does take the S&P 500 back to the 50-day moving average, and while this does not mean that the pullback is completely over, it certainly does brighten the short-term technical picture out somewhat. Breaking back above the 4600 level, though, is likely to be key to sustaining this rebound in the S&P. Now, over in Europe, European equities also bounced and have regained the level they last achieved on 24th February when Russia first started an invasion of Ukraine. Now here I couldn't help but notice that this is a great example of how difficult it can be to time short-term pullbacks in equities. In this case, not only did one have to time the exit very well, but also ensure a re-entry at the peak of bearish market sentiment ahead of the most recent rebound. And finally, though, in China, sentiment towards Chinese equities does seem to remain poor. Now, several commentators did view last week's policy comments in a very positive light, but data did show net flows to Chinese equities via the Hong Kong Stock Connect dropped to the most negative on record. Many reports, though, question whether this marked a capitulation, with 18,279 on the Hang Seng being a key technical support level. Now, while the technical picture may be looking less bad for equities, one potential cloud we keep a close watch on is oil. WTI oil bounced back above $107 per barrel as the International Energy Agency warned Russian crude oil production could drop by as much as 3 million barrels per day, and that the world could be on the cusp of what they called the biggest oil supply crisis in decades. Now, we'd be a little bit less alarmist considering global oil intensity, or energy requirements per unit of GDP, have fallen considerably over the past few decades. This is a risk we'll be keeping a watch on closely, especially given how tight the demand-supply balance is at the moment. From a technical standpoint, we'd most probably need a break above $110 to $115 per barrel for the uptrend to resume. Finally, the week ahead promises to be an eventful one as always. US Fed Chair Powell is scheduled to speak twice this week, as are several other Fed policymakers spread across pretty much every day of this week. Many major economies are also set to release PMI manufacturing data. Singapore set to release CPI inflation for February, and a few major emerging market central banks are scheduled to set policy rates. So busy week ahead where we keep a close eye on equity market technicals and of course watch for any surprises from what is a large number of Fed policymaker speeches. So if you enjoyed this podcast, please don't forget to rate and like it. Thanks for listening. We wish you a happy trading day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.